3.6 million recorded cases. And remember, it was the 31st of December that the Chinese government first reported a cluster of novel coronavirus cases in Wuhan. It was about the 30th of January, so about a month later, that the World Health Organization declared that it was a public health emergency. Again, about a month later, so late February, 27th of February, ScoMo announced that Australia was going to go into its emergency response plan, saying that it was a domestic emergency. Within a few days after that, start of March, we had our first death in Australia, in Western Australia. It was on the 1st of March. And then about a month later, so coming into the end of April, which is where we're sitting at now, we've actually started to see Scott Morrison and the Australian government and indeed the state governments talk about easing the restrictions as a result of us flattening the curve. We've gone from the world never hearing of coronavirus on the 31st of December through to the 30th of April and us maybe a glimmer of hope of coming out of some of the restrictions and moving back into a normal world. So that really takes us onto our next slide, which will show you that one of the biggest economic impacts, obviously there's some devastating health impacts, but one of the biggest economic impacts we're seeing from the virus is the unemployment rate. And no better is that illustrated than in the US. So as we can see there, the weekly average for jobless rates reported through to the IMF from the UK, from the USA, was set at about the 350,000 mark. And then in recent times, we've seen up to about 6.65 million people. Now, if we take that globally, the International Labour Organization, ILO, is talking about somewhere in the vicinity of about 2.7 billion workers being affected. Of that, they're saying about 1.25. So that's being affected. That could be, a loss of job, or it could also be just reduction in hours, reduction in pay. So fairly, a gross figure. But then if we look a bit deeper, 1.2 million people are considered to be extremely vulnerable. They're mainly people in hotels, food service, manufacturing, retail stores. Of course, this is about 38% of the global workforce. And really, the ILO are suggesting that about 1 billion people could face losing their job as a result of the coronavirus. And then as far as what that looks like from a GDP point of view, so what our countries are producing, or what the globe is producing, they're looking at a decline of about 6.7% just this quarter alone. So that's a fairly large drop. To show the impact of that drop, we'll move on to the next slide. And you can see there, these are comparing the Great Lockdown. So that's what the IMF has decided to call this current recession, and we are indeed heading into a recession with all forecasts suggesting it. So if we compare that to the global financial crisis, you can see that the two barely are even comparable. So the GFC GDP year-on-year growth percentage changes there in the top left-hand corner are clearly much more drastic in our Great Lockdown of 2020 compared to our GFC of 2009. Indeed, the IMF is saying that this global decline is the worst since, and could even potentially surpass the Great Depression. Now, remember, when we see pictures of the Great Depression, we see, a lot of hunger. There was a lot of large fallout for the developed nation. A lot of us, and including Australia, we won't have a lot of that affecting us. When we see a big fallout, it's usually the emerging markets that are affected mostly. So in the GFC, a lot of Asia called it the Great Food Crisis, the global food crisis, because in Asia, they were running out of food supplies, whilst in Australia, the worst we saw really was maybe a bit of a crash in our stocks. So as Australians, we're going to be pretty lucky, but for the rest of the globe, especially emerging countries, they could be seeing a lot of turmoil. So if we then move on to our next slide there, speaking of our share portfolios, so the US S&P 500 indice, one of the largest or most tracked indices for the US, started the year strong. It grew throughout the start of the year, and in fact, that chart there shows that the US really was quite late to appreciate the severity of the novel coronavirus epidemic. So pandemic, as you can see there, the straight all the way through February, the stock market continued to rise, even though the first American death was actually in February. So we still didn't really understand. But then within a month, the market crashed to record lows, and it dropped so rapidly that it tripped the market circuit breakers, and they went into an automatic trading halt on one of the days there. And so we've calmed down to a point of 2,300 points coming into the end of March. But since then, we've seen a bit of a rally. And so where has that rally come from? Well, on my next slide here, you'll see that the rally has really come from people having nowhere else to put their money. So we're seeing a massive reduction in the yields of bonds. There's a bit of talk about the bond market and some inverse yield curves and the like. But what essentially we're seeing on a more broader spectrum is that governments, reserve banks, federal reserves, they're all lowering their interest rates in an attempt to try and stabilize the economy. And as a result, our yields on bonds are dropping lower. So it's a double-edged sword as well, because at the same time, investors are panicked a little bit in March with such a rapid drop, and they fled to the bond market trying to soak up some more safe havens, and as a result, drove down our yields even further. But with such low yields, obviously cash is quite cheap, and so we do still see some early money returning to the market, which is boosting up the indices around the world. Whether that's a short term or a long term, we won't know, but Sam's going to discuss a bit later on how we can navigate that volatility that we've got in the early days. So next slide, we'll look a bit closer to home. So the ASX 200, as it typically does, has followed a very similar curve to the US. Noticeably that it's taken us, a good 10 years to get back to pre-GFC levels. We only just surpassed them late last year. And then clearly we've had a drop off of about 36.5% from that late March until the bottom of late April. But we've come back. We've come back to the right slide, and we've also come back to a bit more of a healthier point in the share market. One quick note that I'd like to make on the difference between the ASX 200 and the S&P 500. The Australian ASX 200 is pretty much all banks, mining companies, and you throw in the odd grocery shop here and there. And as a result, we've got some really heavy yield payers. So our banks pay out a very, very large dividend compared to global standards. Something around 90% of earnings are paid out of the ASX 200, and we typically get a 6.8 gross. So whilst people are thinking, it's taken me, this bloody stock market, it's taken me 10 years for my portfolio to recover. That is true if we're just talking about the capital value of your shares. But if you add in your yields, you'll find that our performance has done quite well. The best indice, I guess, to benchmark that against is actually the S&P 500 accumulation index. The reason being that American shares pay out almost all of their earnings. They don't reinvest it. So other way around. Australians pay out all their earnings, whereas Americans keep them and reinvest them. So as a result, their share prices can accumulate quite quickly. So yeah, you might be thinking it's taken us 10 years to recover, but let's not forget that we've had some really good yields in that time. All right, so that's the end of the bad news. If we move to our next slide, we can start to see a bit of good news. The first good news is that ScoMo is back from holiday and leading the country. I am a fence sitter. I'm quite proud of the fact that I don't vote for either party based solely on on their political spectrum. I was not a big fan of ScoMo after the fires, but my brother, who is a massive Labor supporter, is quite upset that I think he's done quite well. I think the government's responded to this quite well from an economic standpoint. And let's have a discussion about that now. So, as we can see there, we have successfully flattened the curve. So what they wanted to see was a transmission rate, a communal transmission rate. So not people coming in from overseas, but a community transmission rate of less than 1. And we've achieved that. I shouldn't say we, it's not like I've done anything. All I did was stay at home. But as a country, we've achieved that. And as a result, we've successfully flattened the curve and might be looking at a reduction in our restrictions. But unfortunately, we've actually been a bit of, we're a bit of a victim of our own success. What we have failed to do is obtain a herd immunity, which is actually, whilst I say failed to and it sounds like a bad thing, it's actually a good thing. To obtain a herd immunity, you need really the vast majority of the population to have been exposed to and caught the virus and built up an immunity. And of course, that only happens in our stronger population. So what that essentially means is you get a lot of people sick and even a lot of people dead. But by not having a herd immunity, the only way we can fully reduce restrictions and have everybody back to normal life, really at this stage, is the invention of a vaccine. So whilst things are going to slowly return to normal, from all reports from the government, it is going to be very slow progress back to some sense of normality, really until that vaccine hits. So some more good news on our next slide. You will see that Australia, and in fact the world, has made some massive commitments as far as equity funding and stimulus back into their respective economies. This was accurate as of the 21st of April. So that's, almost 2 weeks old. And the situation is changing so rapidly that I have no doubt these numbers will be inaccurate, but they are at least illustrative of the fact that as a percentage of GDP, countries are really putting a lot of funding out there to stimulate their economy. In Australia alone, we saw that $750 cash payment that I believe they did twice over to eligible Centrelink recipients. We had the RBA reduce our cash rate to 2.5. They've left it on hold at 2.5 at the last update, but I wouldn't be surprised if it does drop again. I don't know. Clearly but when they talk about quantitative easing, the RBA can drop the interest rate again. But there are other types of quantitative easing, like forcing banks to have different liquidity requirements or forcing banks to buy bonds or issue bonds. So there's more out there than just dropping the cash rate, but they might do. We also had the government give out the job seeker, job keeper, telephone, domestic violence prevention, and free childcare service stimulus. So all up, we're almost pushing the $100 billion mark. That, of course, pales in comparison to the US, who did the largest stimulus in history of $2.2 trillion. And closer to home, we had Japan with almost $1 trillion put into their economy, which, as you can see there in the slide, as a percentage of GDP is huge. And anyone who's been following the Nikkei 225 will know of the lost decade, which turned out to be the lost 3 decades. So Japan has really not seen much economic growth for 3 decades. And as a result, they're especially with an aging population and being so close to China and part of the Asian region, they're very worried about the impact to their economy. What Japan does have is a really good culture of saving. So they do, funnily enough, have plenty of money to throw into their economy and to stimulate, and that's exactly what they've done. So a bit more good news then if we move on to our next slide. Whilst the short-term news is bad, the IMF, so our International Monetary Fund, are projecting that we're going to have a really bad year and a really bad recession and quite a substantial decline, followed by an even more significant and even more robust rebound. So some of their projections are about a 5.8% growth for the entire global market for the year 2021. Now, that's after, a significant drop, maybe even a 20% drop this year. So that still won't get us back to where we should be. But it will get us a long way there, and we'll see a fairly sharp recovery. But that is really contingent on one thing, which is the etymology behind this disease. So we don't know how quickly we will recover. We don't know how quickly we'll find a vaccination, and we definitely don't know how large of an impact this is going to be to the developed nation, because a lot of South American and the African continents have reported quite low cases, and that could simply be because of their reporting. So we're yet to see really where this will end, but most governments and most international bodies are quite confident we'll have a good recovery. That's further illustrated in our next slide there. To really, I think this is a good way of seeing that we're going to have a bad 2020. I think we're already having a bad 2020. That's not a surprise. And whilst they are projections, short-term projections should be quite consistent. But also globally, we're going to have a fairly decent recovery in the following year. Yeah. So what else is good news? So on the next slide, we have something that could potentially be good news. So I'm not an economist, and I always think that economists are like those guys back in medieval times that used to throw the ruins on the fire and decide what way the battle's going to go. No one can predict the future. I don't care how many degrees you've got from Harvard. And nothing highlights that more than oil prices. So ever in a day, economists will tell us that low oil prices are good for the economy. The standard philosophy goes that lower oil prices means lower manufacturing costs. Oil is in almost everything we produce, especially plastics. Cheaper fuel prices mean lower transportation costs, lower costs of goods, more disposable income, which should mean a stronger economy. But a lot of the research has shown that there's very little correlation between oil prices and the share market. What it has shown is oil producing countries can be significantly adversely affected by oil prices. So we've got the OPEC cartel. We've also got Russia, big oil producers, Australia and the US, of course, at a small degree. So those countries, they're really going to struggle to be able to maintain current stimulus if their receivables have reduced so much based on such a low oil price. Indeed, for the first time in history, there was a day this year where the countries were paying about $4.47 per barrel for you to take oil off their hands. So it went into negative territory. That's, of course, the result of futures contracts, which is why you should never invest in futures. But let's not forget, it was only in 2019, at the very start, that OPEC and Russia made a deal to reduce Brent crude production because there was a glut in the market based off China and the developing nations starting to slow down. So oil prices were being buoyed up by an agreement. And as soon as global manufacturing reduced, I think it was Abu Dhabi or Saudi Arabia from memory, I think Saudi Arabia, just flooded the market and went, oh, well, the agreement's obviously over. They threw a whole bunch of oil out on the market. They've recently gotten back together with America leading the way and reduced supply again. But yeah, we could really foresee an extremely long period of low oil prices, which will have a negative effect on a lot of our oil exporting countries, but should have a positive effect on net importers of oil. So that takes us to chapter 3. So there's a lot of bad news out there, but I believe the bad news is short term. The good news is long term. But it is a tale of caution, hence the watching out for the kangaroos. And that is, everyone saw thanks, Chris. Everyone saw the kangaroo sign. Excellent, thanks, mate. And that really is global debt. At the end of the day, and when this actually, funnily enough, when this all came out, I said to Sam, our next speaker, I said, look, it'll obviously be short-lived because the only thing that really drives large economic downturns is debt. And I still stand by that, even though the share market dropped lower than I expected. But this is really where we might come unstuck. So we saw that stimulus and spending as a part of GDP is about 10 times GDP, as a percentage of GDP. we also see now this number was produced in the first quarter of 2019. The numbers aren't out yet for how much debt the sovereign nations have gotten into, but we could be, pushing $300 trillion worth of debt, which for a lot of countries that have debt in their sovereign currency, that's fine. If you're Australian, you've got Aussie debt, or you're American, you've got US debt, that's fine. You just print money to pay off your debt. Yeah, it devalues your currency, but you can't default on your own currency because you own it. But a lot of our emerging countries, because of this exact fact, a lot of their debt is in US dollars. So if they see a lot of large inflation drive down their currency values, or if they indeed start to do things like print money to pay back debt or devalue their currency intentionally to pay back debt, all it will do is actually drive up the price of their debt. So really, already now, the IMF is starting to call for some of the larger states and larger developed states like America to just simply start forgiving debt. And really, it's uncertain what the impacts of forgiving such a large amount of debt could have on the global economy, because at the end of the day, one person's debt is another person's asset. And so this is sitting on the asset ledger of a lot of large nations, and to forgive such a large amount of debt, we're talking 320% of global GDP, that could have some significant impacts. So in closing, I'll hand over to Sam, and I think we might open up for some questions. But in closing, yeah, it's bad. It's bad on a fundamental level when we're talking investments, because none of us like to see our share portfolio drop. But also, it's bad because there's people in developing countries who are going to lose their job, lose their livelihood, and the loss of income will probably end up taking more lives than the virus itself. So it's bad. But we're human beings. We've got some very smart people leading the monetary policy of most of our developed nation. We will come out of it. And from what we've been told, we will come out very, very well and very strong. So, now is the time for us to really start to lead this, and as a country, and also as investors, and try and have some confidence back into the market. So that's me done. Thank you very much for your time, guys.
Thank you, Luke. So now we'll put you on to the next section, which is the Sam.
Wonderful. Thank you, Chris and Luke. Today I'll go through a couple of areas to consider as we work our way through these uncertain times. We're currently seeing unprecedented times both socially and economically. We have no data or records of historical events such as this to use as a reference to what we are currently seeing. But this should not be a reason to throw everything we know out the window. One of the greatest investors of all time, and one that has been able to consistently beat the market, is Warren Buffett. And he has many famous sayings out there. One that stands out at the moment is, attempt to be fearful when others are greedy, and greedy only when others are fearful. Buffett is talking about taking advantage of situations when others are looking to sell assets. There's a large amount of fear in the market at the moment, but with a structured approach and an understanding of the risks involved, we can use this time as an opportunity to meet your ultimate financial goal and take advantage of the current situation. On the next slide, about the current investments, about people's current investments at the moment. If you have funds invested through either your superannuation or your personal name, stop, breathe, and remember why you invested in this way. Always keep in mind the big picture. If you're investing for the long term, avoid rash decisions based on short-term volatility, which is quite key. If your strategy is sound, stick with it and recognize that short-term market wobbles happen. Markets run in cycles, so it really does pay to be patient in these situations. One question I'm getting asked on a regular basis is, should I sell my current investments and hold it in cash till the market recovers? The common answer is no. If you have time to ride through the downturn and your strategy is sound, ride through it. I do highlight here, this is the common answer. Each person is different, but that is what's popping up more and more. The key word here is also time as well. And I'll touch on this in a couple of slides. But by selling assets now, we'll crystallize our losses and we'll miss out on the recovery of the market. You'd be selling at a time when everyone is fearful, and the market has reflected this by dropping in value of your portfolio. This can be detrimental to your balance of your portfolio in the long term. If you're looking at taking advantage of lower prices and have a sound strategy, now could be a great opportunity to be greedy when others are fearful. On the next slide, the graph is actually a little bit hard to read. It's trying to capture quite a lot of data in a small space, but is great at showing the market movements and the business cycles. Although this does not include the current drop, it does show two key points to consider, and I'll try and go through them now. The first is growth assets. The first is the growth assets performance versus defensive assets performance over a long period of time. It shows how $10,000 has grown since 1989, at the very beginning of the graph, to 2019 in different asset classes. We can see that if you invested in US shares or Australian shares, which are the top two there, your initial investment of $10,000 will be worth $189,000 or $146,000 respectively. Comparing this to the cash rate of $51,000, it's quite significant. What we can take out is how growth assets perform over the long term, and this includes the short-term volatility from both the dot-com bubble and the GFC. So we've seen two of the major crashes in this graph, and yet they've still been able to bounce out of it. The second is to look at the recovery from these previous crashes, and it shows, if given time, markets do recover. It's not always quick, but they do turn around. If we don't sell down assets in a drop, we get the potential to be there for the recovery. The second point is why it is so important to understand time when investing and allowing investments with certain risks the appropriate time to run their course through the bad times and the good times. It comes back to time and waiting for recovery. On the next slide is the start of our second part. On the other hand, we have people that are looking at taking advantage of the market. And as Buffett would say, this would be greedy. To be greedy while others are fearful. This can be a great opportunity to enter the market at a discounted price compared to what we saw 3 months ago. We will go through some strategies to try and take advantage of the current conditions while continuing to be cautious, as this is a unique situation, and we want to be investing with caution there. When we look at investing, we have to consider two key questions. What do you want to achieve in the investment, and when do you want this to happen? Each person's goals will be different, and this is okay, but we want to make sure that you have a goal to work towards and a time period you'd like to achieve this goal. By establishing a clear goal that is realistic, we can understand the big picture behind your investment and plan to achieve this goal. The benefit of having a clear idea of the goal and the big picture means we can follow a set out plan and, in most part, ignore the short-term volatility. This stops us from changing our plan every time different news comes out and helps us to be less reactive and more prepared for what will come. By establishing a suitable time frame for the investment goal, we can reduce the risk of withdrawing funds when markets are in downturn. An example of this is we would not be investing in growth assets or 100% in growth assets today if we would know that you want to withdraw the funds within 2 years' time. So say you want to use the funds for a holiday, you want to purchase a property or purchase another car, and we know we want to use those funds, we don't want to be invested 100% growth for that. 2 years would not be suitable for a risky asset like property and shares. It is not to say that the portfolio won't go up and you'll be in a better position than what you'd be in if you left it in cash. It's just assessing the risk of another potential drop and the likelihood of a recovery in that time period. However, if we have a longer period, we can build a portfolio that addresses this risk. By planning and understanding our time frame, we can have a sensible approach to riding through the storm and not getting caught up in any other drops that happen. This is why planning and time frames are so important, and we consider them one of the foundations of any sort of investment that we start to look into. On the next slide is market timing. This should not be confused with the last slide that I was going through of time periods for investing, but it's about when to actually buy shares. Market timing is a hot topic at the moment. And I'd like to start by saying not many investors can successfully time the market. Although I'd rather buy in today's market than if I was to buy 3 months ago. However, history shows that best and worst days often cluster together, which makes timing incredibly difficult. It can be better to be in the market than waiting on the sideline. However, it is human nature that investors generally buy at the top of the market and sell at the bottom. History has shown this time and time again. What we do is hear really good news about the markets. It's been going up for years, then we buy in, and when it's close to the top, we go through the market crash. We think it won't come back, and we sell at the bottom. This happened quite a lot with retail investors, and basically what they were doing was we were seeing such a great run coming out of any sort of crash out of the bubble. We're buying at the top, we go through the bubble, and then we sell at the bottom, and we don't follow through that recovery period. On the next slide is a strategy that we help combat timing and making sure that we're not getting it wrong, or at least avoiding it as much as possible to reduce that risk. A strategy we're using to enter into the market in a cautious way is called dollar cost averaging. Dollar cost averaging simply involves investing the same amount of money into, say, shares or managed funds at irregular intervals over a period of time, whether the market prices are going up or down. This averages out the purchase price over that total period, and investors keep investing. This is a great strategy to gain exposure to the market while also avoiding timing the market, as the statistics show we'll often get it wrong. I've used a 1-year period to demonstrate this with $1,000 intervals per month on the graph on your screen. As you start investing $1,000 per month, we start off by buying shares at a higher price, shown in the orange line at the beginning. From the shares price being high, we're receiving less units in that share from what we're purchasing. As the markets continue to decrease, the units we are able to purchase from the $1,000 per month increases, shown with the blue line. And then once we, in this example, we meet the bottom, which is midway through, convenient for my easy maths, to see where we're buying units and receive $1,000, it reaches a sort of a plateau there. When the market starts to turn around and increases in value, we again receive less units from the $1,000 per month we put into the portfolio. This strategy averages out the price we're purchasing the units and reduces the risk of picking the market at the wrong time. So by the benefit of us investing dollar cost averaging over this 12 months is if we were to go all in at the very beginning, we would have missed purchasing the lower unit prices in that June-July period, and we would have had a higher average of what we're seeing there. The downside of this, though, is if markets go up, you miss out on some of the gains, but this is a risk reduction strategy. When we reduce risk, we can also reduce the return in a portfolio. With today's market and uncertainty and volatility, we believe this is an appropriate risk mitigating tool to consider going forward. On the next slide, we have, following dollar cost averaging, the next couple of slides will go through diversification. I'll explain how diversifying a portfolio can reduce an element of risk. A fundamental of investing is risk and return. This is where assets that hold higher risk, i.e. property and shares, should outperform defensive assets over the long term. The key word here is should. There's no guarantees when investing, and that is the risk of the asset. An example of this is we expect that holding your money in property should outperform holding your funds in term deposits over a 10-year period. Jumping on to the next slide. As the graph before showed, it would be easy to assume that if we hold one asset, that it is considered high risk, i.e. property or shares, compared to holding a pool of similar investments, that the portfolio would have the same amount of risk. We would expect that it to offer potentially the same returns. However, it's a little bit different. It would actually be incorrect. There are two types of risks involved with an investment portfolio. The first is the risk of the asset underperforming and not going to plan as we expect. This is a risk that's unavoidable and would have in both situations. By having this risk in the portfolio, you are both rewarded there. So that is, per se, correct that they'll both be the same there. But onto the next slide. The second risk is having all of your eggs in one basket. So below is the person that's holding all their portfolio in CBA. This is a risk that we can avoid by diversifying your portfolio, not having everything in one basket. And by being able to avoid this risk, we're actually not given a reward to have it. We see this a lot in one-share portfolios made up of only Australian companies or portfolios that hold just property. By holding either that one company or a portfolio made up of one asset class, we run the risk that the company having an unforeseen event that is detrimental to its value. We have seen this with the current virus affecting travel companies. This is an area that has been hit extremely hard, and if we had all of our investments in that area, the portfolio would be hurting a lot more than other portfolios that are out there that would be diversified. This is not to say that one stock portfolios or one asset class portfolios won't do well. I would love to have had 5 properties in Sydney over the last 5 years. It is just to explain that there is 2 types of risk when it comes to building a portfolio. And if we can avoid it easily and reduce that risk, then it's something to consider on all portfolios that are out there. Coming up to the last slide, which is a recap of the points. If you are currently invested in the market, breathe. Market crashes are expected. We just don't know when they will happen. But what we want to do is make sure we're not making any rash decisions and focus on the long-term objectives. If you don't need the funds today and you have a sound strategy, leaving it where it is can be the best thing you can do. If you're looking to take advantage of this downturn, set a goal you want to achieve and a reasonable time frame you want to achieve this goal. Don't try and pick the market, but be happy knowing you have it at the discount, and also be aware that it can continue to go down, and this is okay. Try and mitigate your risk through strategies like diversification and dollar cost averaging, which is quite key there. These are all areas we'd be happy to talk to you about, and further if you want any assistance or you have any questions about it, we're always here to help you. Is there any questions, Chris, that popped up?
Thank you for that, Sam. Not as yet. If anyone did, if anyone does have any questions, feel free to either send them through on the group chat, for the Zoom group chat, or if you like it, because we're finishing out the presentation bit, so certainly you can unmute yourself and have a chat to us now, or ask Sam and Luke any questions that you may have.
No, everyone's too scared.
Everyone's too scared?
Yeah, I would be so. Good.
It was quite in depth that both of you guys went through.
Does everyone, so if you wanted to ask it in the chat, and feel free to cut me off while I'm talking, but if you want to ask in the chat button is in the middle, at the bottom of your screen. If you want to unmute yourself, it is the far left bottom of your screen. There's a little button called mute. If you type them to Chris, he'll ask them. And if you don't want to ask any questions, you feel free to just jump off. No one's doing that. No one's doing either thing. I will ask a question. Am I allowed to ask a question, Chris?
You are, yes.
Excellent. Okay, so I will ask it of myself if I have to, but Sam, some of my clients are in industry funds.
Yep.
Just in the balanced portfolio of an industry fund, like a Q Super or a Sun Super. And look, typically it's the wife, because a lot of my clients that are in Q Super are nurses.
Mm-hmm.
And then again, typically, I promise I'm not trying to be sexist here, but just typically I'll have the husband will be in a retail fund and usually has a bit of a higher balance. And they've been coming to me recently, and their retail funds, which are invested in index funds, have performed really poorly and have had a big crash.
Mm-hmm.
Yet the industry funds like Q Super and Sun Super have barely moved. Do you know why that might be?
It could be, there's a lot of different reasons it could be, but the main one that we're sort of seeing at the moment is your industry funds hold unlisted property. Unlisted property allows them to choose a time in the year that they'd like to value that property, which is quite convenient for any funds out there. When you're able to choose the time of the year that you want to value it, obviously you're going to choose the period and time that it's doing its best. So we're seeing them value the property as of the 1st of January this year, before markets sort of crash, which is holding up their portfolios there, compared to if you're invested in an index fund, that's just showing what the real value of your portfolio is today. So that's not to say that industry funds won't drop. It just means that they have that flexibility to choose that time, and it might not be a true representation of what the dollar value is inside their portfolio. For instance, there.
Mate, that's exactly the answer I was hoping for.
That is very good. And actually, I will note there were a couple of articles over the weekend that were out, mainly pointing towards Host Plus there, who so far out of all the Australians who have requested a withdrawal from super, Host Plus have had close to 40% of those inquiries. Obviously, a lot due to the sector that their members actually work in. Now, similar or to exactly the point there that Sam was raising, where most of their funds are actually invested in these unlisted properties, and what they're finding is purely now trying to actually find the cash to pay these members out. They're struggling considerably. So what we'll probably have to see is say the sale of some of these buildings for considerably less than what these funds had originally thought they were first worth, which will be interesting to see what the result is from that.
Well, yeah, and it's and so on that point, some of that unlisted property are airports. So I wonder how they're going to go trying to offload an airport in a time when no one's allowed to fly. And indeed, how do you value an airport when it's not allowed to make any income? So yeah, it'd be interesting.
The other thing that they could do, and we're seeing a couple of industry funds do, is change their PDS and what their bylaws basically that they follow. What they'll change it to is they have discretion on whether they pay out the funds right away. And this allows them to go, well, we don't have the liquidity to do it right now. We might not pay out the full amount that you've requested to do. So if you are in high times and you need the $10,000, they do have discretion on whether they pay it out or not, which is
it makes sense.
A little bit difficult.
Yeah, it'd upset you if you're the client, but it makes sense.
It makes sense by the fund.
Yeah, from the fund, you'd hate the fund to fall over just because everybody's rushed out to pull out their 10 grand.
Exactly, but try saying that someone that needs the $10,000.
Well, that's and actually, Josh Frydenberg has already put a couple of funds on notice. CBus as well, being one of them, saying to them, "Hey, look, guys, you've got to get this, get cash and cash out to the members as quick as you can." So it'll definitely be a watch this space next few weeks.
Yeah, and we saw something very similar in the GFC. And there was actually a little bit of an arbitrage opportunity there. So some people were looking at it and going, well, we've had a global financial crisis. The markets have crashed by, about a third or down to a third. And they had their industry super funds hadn't moved in value at all. So I had a few people, other advisors actually, because I wasn't an advisor at this time, so it wasn't me or my clients, but I had a couple of old advisors tell me that at the time they moved their personal funds out of an industry fund and invested it in index funds just because they got such a large arbitration between the overvalued unlisted properties versus the indices. So yeah, it could be a bit of an arbitrage opportunity out there at the moment if anyone was looking to do a bit of work around their super fund.